Welcome back to Cheddar's Opening Bell, everyone. As U.S. stocks are continuing their sell-off over fears that rising COVID cases could stunt economic growth. We are continuing to watch the Dow Jones Industrial Average down by about 2% this morning, and the NASDAQ Composite, the tech-heavy average, lower by about 1.3%. Meanwhile, the S&P 500 also seen lower by about 1.7% right now. There is not a safe sector in sight. Right now, we're also seeing energy down, leading the charge actually in terms of the decliners. That's down by a little more than 4% at this point in time, just under 4%, I should say, rather, at this point in time. Financials, industrials also rounding out the biggest laggards from a sector perspective. But the U.S. stocks are continuing their sell-off over these fears about the rising COVID cases and the economic growth that could be stunted as a result, as I was mentioning. So for more on the markets, Thomas Hayes, chairman of Great Hill Capital, joins us now. Thomas, help us break this down. Witnessing a bit of a market meltdown here, and this is not just today's activity. Some of this started last week, the first week of decline that we had seen in several. And so can you put this into context for us?
Yeah, well, thanks for having me, Brad. I think that when you really started to see the earnest weakness was on Friday, when you heard from California that they were going to put restrictions to wear masks indoors. And that kind of concerned people because it brought back a lot of bad memories. And you're seeing some of the cases spike up with the Delta variant. So I think people are, with markets near all-time highs, people are doing a little profit taking. And some of these sectors are getting hit hard. The risk-on sectors like tech is getting hit hard, and particularly the reopening trade like energy, like banks, like industrials are getting hit the hardest because those are the ones that require aggressive GDP growth. And right now, people are worried if we have another shutdown or that type of thing, these stocks would be hit the hardest. But on the flip side, the defensives are doing quite well today. As a matter of fact, you see consumer staples, think diapers, Kimberly-Clark, bleach, Clorox is doing fine, and some of the utilities are doing well. Dominion Energy, Duke Energy, et cetera. So the market's kind of putting some money into defensives, biding some time. And actually, this is very common this time of the year. If you look over the last 20 years, on average, utilities, staples, and healthcare tend to outperform in the summer when the market, general market, is a little choppy. But we started using this opportunity a bit this morning to add to some positions and to start some new positions as well.
Where were those positions that looked the most appetizing for you? You were mentioning consumer staples. Consumer staples is the best of all of the laggards on the day. It's only down by about 0.6% for the S&P 500 consumer staples sector that we've been tracking as compared to the rest of the names, the other 10 sectors that are also in negative territory. Where are those opportunities that you're sensing though?
Yeah, so I think staples are certainly going to do well. We've been building staples for the last couple of weeks. Once the 10-year got below 150 basis points and it's in this 120 to 150 basis point range, we wanted to have some defensives. And also those dividend yields are going to be more attractive on a go-forward basis with yields compressing in the short term. But what we did today was actually, we're not interested in buying things when they're up. We're interested in buying things when they're on sale. Mm-hmm. So we started some Intel, which we think is pretty attractive after their announcement of going after global foundries. We added to Alibaba, which is a very controversial stock right now with all the noise going ahead with foreign listings, with U.S.-China relations. But we believe the vast majority of that is priced into the stock at these levels. It's down some 30% from earlier highs this year. And we think these levels right around 200, 210 range represent a great long-term opportunity. Because when you look at 400 plus Chinese listings, $2 trillion in liquidity, it's probably not in the Chinese government best interest to close out all U.S. listings and lock out $2 trillion of liquidity, which grows jobs in China, which grows innovation in China, and we're betting on people to take rational behavior based on their best interests.
Tom, you mentioned you've been building a few of these positions over a couple weeks. So with that in mind, we've had even more economic data come out. We got retail sales last week. We even heard from Fed Chair Jerome Powell, who was testifying in front of Congress last week for 2 days as well. How do you start to also kind of price in what the Fed chair is saying, either about transitory inflation or about any of their timelines for what they may do in terms of getting back to normal, what would be normal for the Fed, even in spite of wanting to also remain accommodative for as long as possible?
Yeah, it's hard to get bearish with the Fed this accommodative. As a matter of fact, on Friday, I looked at the Fed balance sheet. It was at an all-time high, and you can't fight the Fed. Chair Powell has made it explicitly clear his number one priority is full employment. We still have 9.3 million unemployed, as opposed to last February before the pandemic, we had 5.7 million unemployed. So he's going to keep the pedal to the metal. His argument for transitory is getting some legs because you've seen a lot of the commodity complex roll over. Lumber's absolutely crashed. Grains have come back. Copper's come back a little bit. What we need to be wary of, though, is if we start to see it in wages, because wages are sticky, and that is going to be the trigger, I think, when they have to start to get aggressive on the tapering front and then down the road on the rates. But we're not really seeing meaningful wage inflation at this point. And until we see that, and I don't think we're going to see it because you've got a huge amount of supply of labor that's going to come back on the market in September after extended unemployment benefits expire. So the real tell will be October, November. If you start to see wages increasing despite the new supply of labor, then you could see them putting the brakes on tapering and starting to do a bit less.
Okay, two things I want to ask you about. First, we'll go to cryptocurrency. As we're taking a look at Bitcoin, as I'm keeping tabs on it here on my screen personally, it seems like 30K is the floor or the support that many technical traders are looking at right now. This broader market meltdown, do you believe that that is going to play into the broader cryptocurrency space as well? Is there any correlation that you've been able to draw, or are they living separately at this point in time?
Yeah, no, I think they're intertwined. I do think if you see the meme stock trades continue to get run over, it could certainly impact cryptocurrencies because it's kind of a similar investor group that's highly leveraged in the crypto market and highly leveraged in the meme stock trading. So to your point, that 30,000 level is critical. If it can hold that level, maybe the worst is behind it. But if it breaks that level, the floor could be meaningfully lower. So we have to watch that. And what I'm looking for is how does the market behave after 11:30 when the European markets close, and then how do the markets behave after 2:30 after margin calls in the U.S. Those tend to be the weaker points of the day, and that'll tell us a little bit, do we get a end of day rebound after all the noise is out, or do we get further weakness? My bet is that we'll probably start to see a little bit of buying after 2:30 into the close because some stocks are on sale. And like I always like to say, Wall Street is the only place when they hold a clearance sale, no one shows up. We're going to find out before 4 o'clock if buyers show up for some of these stocks that are high quality and down quite a bit. And then the last thing I would just say, Brad, is, watch earnings. That's the name of the game. Earnings estimates went up again last week. They're looking at $213.59 for the S&P in 2022. We think by the time earnings season is up over the next eight weeks, we could see that number move to 220, 225, and that makes the market look a little bit more reasonable. So in the meantime, we use weakness to add to high quality over the long term. We're still only a year into the new business cycle, so it's going to have legs for some time to come.
Wall Street, the only place when they hold the clearance sale, no one shows up. Tommy, we got to send that one to Dude with Sign on Instagram. Maybe you'll get on a cardboard cutout or something like that. Just lastly, while we have you, just a brief earnings preview for us. What specifically are you going to be watching this earnings season? We'll have some airlines coming out this week with Southwest. We're also going to have United and American, but we'll also have some interesting names, of course, that are noteworthy to track in the FANG segment, like Netflix. We're also going to get, of course, Chipotle that we'll be keeping an eye on, and American Express. Any of those specifically that stick out to you that you're going to be watching closely for any commentary or the language coming from execs?
Yeah, I think the guidance, Netflix is an important one. They have a slate of content coming the second half of the year that had been delayed. I want to hear more about their gaming system. That's obviously part of FANG, and that will be important to tech sentiment. So that's one that I'm watching. And then I want to hear the airlines. I do think that the airlines are going to come out pretty optimistic because you're seeing the TSA pass-through numbers, even though business travel's down. Leisure travel has more, really stepped up, and leisure travel is greater than it was pre-pandemic. Business travel still down a little bit. So I think they're going to be optimistic. I think their guidance is going to be optimistic. And if that's the case, it could do something to bring us out of this little funk that we've started the weekend with.
Right. All right. There's a good look at which names we're going to be tracking closest here over the course of this week. Tom, always a pleasure to get your insights, and thanks for joining us here to really break down some of the declines that we are seeing here on the day. As of right now, the Dow down nearly 800, 2.3% there. That's what you're seeing on the screen in the top corner. NASDAQ down 1.4, and the S&P 500 down by about 1.8. Everyone